Good morning, deal hunters. It is I, Donny Coram, your foreclosure deals coach, and thank you for tuning in to this live Q&A session with yours truly, Donny Coram, on the show where we discuss how regular people can become deal hunters that find, figure, fund, fix, and flip a foreclosure deal with a minimum profit of $25,000. Guys, we're going to jump into the weeds today a little bit about the inverted bond yield curve. Now, this is a pretty technical financial term that people are throwing around a lot right now because it's taking place. So why is this? We're going to discuss what it is, why it's important to you as a foreclosure investor, and what the future of real estate looks like based on the current inverted bond yield curve. As always, this is a live broadcast. Please comment below. If you're here watching live, let me know you're here. I really appreciate it. And obviously, if you have any questions about the inverted bond yield or general questions about real estate investing, please comment below. I love to interact directly with people watching the show. It is a snow day today. District 20, where my kids go to school. I went to Liberty myself. They also go to Liberty High School, class of 95, go Lancers, is shut down today because it's awful snowy and blizzardy outside today, which is nice. Working from home, etc. One of the fun benefits to being a real estate investor is I can pretty much do the job from anywhere. That's what a lot of my clients are looking for when they get started in the investing world, is the location freedom that is afforded to real estate investors. Literally, you can be working on the job anywhere. Well, today, that freedom is causing as many problems as it is solutions, if you will. In an inverted bond yield market like we're in today, there's a financial situation amidst that's going to change the landscape of real estate investing a pretty significant amount in the year to come. Okay, so 2024 is definitely going to be a turn year, and a lot of people are currently wondering, is it going to turn for the better, or is it going to turn for the worse? Because the best way to describe 2023 was pretty much flat. You know, we didn't see a huge increase in prices. We did see a decrease in prices for a short stint as the rates baked in, but they trickled back up a little bit, and they're back to what we would call stable to normal. Okay, what does an inverted bond yield mean? Well, the first thing you're going to see when you hear that term is that interest rates in the market are expected to drop. Interest rates, obviously the mortgage interest rate, is what drives a lot of investing because buyers' power to buy a property is driven by the interest rates, right? So if the interest rates go down, more buyers should come back to the market. Good news, right? Well, kind of, because if the inverted bond yield continues at the trend it is right now, this could be a temporary thing leading into a recession. Let's hop in and define what an inverted bond yield actually means, okay? So you've got the bond market, and a bond is basically a loan that private investors give to the government or wherever the bondholder is to lend money over a period of time. Well, in a normal bond yield would indicate that short-term interest rates are lower than long-term interest rates, right? That's kind of logical, right? The longer you define your money or the longer you invest your money, the greater the rate of return that you're expecting to get, okay? What has changed recently is the bond yield is inverted, meaning the short-term bond yield is actually running higher than the long-term. This is a sign that investors are moving their money from short-term bonds to longer term bonds, basically indicating that they're not super confident about what's happening in the short term market. And can you blame them? Interest rates have been high. Demand on real estate has been low. There's a lot of job layoffs starting to take place. Overall, if you're looking at the economy in the short term, you have reasons to be concerned. So investors are now looking at that and they've moved their money to more long-term stuff in an interest. So the government who issues a lot of these bonds is saying, whoa, we need this money right now. So they're increasing the yield in the short-term bonds to motivate investors to put money into the short term. Now, you would think the higher interest rate would be exciting to investors. Oh my gosh, I can make more money in the short term. But because of all the stuff happening in the economy at the same time, the investor, who is generally risk averse, remember, the economy, interest rates, the market as a whole operate on risk versus reward. Okay, so if there's a lot more risk in the short term, even with the higher interest rates being offered, investors are going, nope, I'd like to have my money stable. I'm going to move it to more longer term stuff, longer term bonds, etc., meaning that they're not going to get as much yield, but they feel like the money is more stable right now. This is going to have a short-term effect on interest rates in dropping the rates down a little bit, which is a much needed relief. Okay, we have been at high interest rates for quite some time now, so having the lower interest rate is going to be a relief. A lot of the buyer demand that has stagnated in the past year or so should come back to market a little bit as rates start to come down. Okay, but let's dig into that a little bit. Today, and generally speaking, it should cost a little bit more to own a property than it does to rent a property. That's normally the case, okay? So people who buy are buying based on the long-term benefits of owning a home, the appreciation, the fact that it's yours, the fact that you can modify it to your taste, okay? But when that gap gets really wide, and right now we're talking comfortably $1,000 or more is the difference between owning a property at today's interest rates and renting that same property, most homeowners are not going to be given a choice anymore. Okay, they're not in a spot where I really want to own so I can afford an additional $1,000 a month. When you figure the average household income in Colorado Springs is wandering between $60,000 and $70,000 a year, and that's probably on the high side, okay, then you got to understand that $5,000 a month, an extra $1,000 a month for your living expenses, your household expenses, is 20% more. No matter how badly you want to own a home, and most people do, when you're looking at that $1,000 gap between the two, you're going to have to look at the affordability of all of it and realize that homeownership is not in the cards for you in the near term. Okay. As a result, a lot of people switched to renting. That created a huge demand in the rental market, pushing rental prices even higher, right? Which had a negative impact because now you have more inventory of homes for sale. Now that inventory curve has not gone to really high levels. We're not facing massive inventory spikes or anything like that. But the point is that people are more likely to rent just based on financials right now than they are to buy. Couple that with there is not as much inventory as there should be on the market because the average seller doesn't want to go on the market knowing they're going to get less for the property and not knowing where they're going to move next. We have seen a massive stagnation in the real estate market in the last 12 months. So what does this inverted bond yield mean for the longer term? Well, today, I think you're going to see a much needed reprieve in interest rates in the short term. We're going to see the rates come down. A bunch of buyers are going to pop back into the market because rates are cheaper and they wanted to buy, but again, because of the gap, they couldn't buy. The problem with that is an inverted bond yield almost always signals that we're roughly 12 months from being considered in a recession. The thing about that is anybody who's been watching the market overall would argue that we've been in a recession since middle of 2022 anyway. Okay, the government is now going to look at the market after this inverted bond yield. This is a signal for them that about 12 months from now, we should actually call this a recession. In all of their great knowledge, the current administration decided they would redefine what recession means in order to not have to admit that we're in a recession. And if you think about how political operates, it makes sense. If you're going to run for office in 2024, we have an election season coming relatively soon. You don't want to enter that election season telling everybody you're in a recession. Obviously, the guy may not be super popular in certain circles as is, but if he's also competing with recessionary economy, the probability of getting reelected goes down. So as they're going to start saying, yes, we're in a recession to allow them to start putting in recessionary implications, like lowering the interest rates, like offering incentives. Many of you may remember Barack Obama entered the economy in what was considered a recessionary real estate market. He, to respond to that, did this huge buyer tax credit. You remember this? $8,000 he was paying buyers basically to buy a home during that recessionary economy. And it worked like gangbusters. A bunch of people came back into the market who otherwise may not have bought homes, and it worked. It pushed the house up. The problem was an artificial inflation that didn't last very long. As soon as they pulled the $8,000 tax credit, the market settled right back down to where it was before. So the point is, when the government interacts, it generally causes more problems than it fixes. But that's what I predict is going to happen. The government's going to have to respond to an actual recessionary market by doing something to prompt people to get back into the home ownership market and prevent an absolute housing crisis from taking place. I don't know what they're going to do. I just know that years past, when they officially define us being in a recession, they get to walk in and say, we're your savior, which is the government's favorite thing in the world to do, and walk back in and say, well, we were heading towards a recession, but we implemented all these policies and pumped all this money into the economy to keep us out of recession. Aren't we amazing? Vote for me. Okay, and that's what the government's going to do moving forward. We will, in fact, hit a recessionary time, in my opinion. And here's where the question becomes, is this a good thing or a bad thing for you as a foreclosure investor? I got to be frank with you. The best years of my life financially took place during a recession. Okay, while everybody was complaining about how bad it was, the real estate investor is now able to identify opportunities in the market at a higher degree, and there will be more opportunities in the market in a recession, and then they can capitalize on those opportunities to do lesser remodels, believe it or not, because in a recession, your value buyers are going to come in droves. What's a value buyer? Well, whereas in a low interest rate market, the demand for really nice housing, actually housing in general, okay, went up to all-time highs when we were pushing 2.5% interest rates. Whether the house was ugly or pretty, you definitely were going to have a buyer. However, nice houses, fully remodeled houses, had all-out shooting matches where people were pushing against each other to bid up properties to never seen before heights. Okay, in the new market, I think you're going to see a lot more value shoppers, people who are looking at the gap I told you about between the ability to buy a property and the ability to rent a property in that same neighborhood. And if there's a smaller gap there, they're going to look at a property and go, well, it may not be the Taj Mahal, but it's better than renting. And if you do a little bit of remodeling to that property, it's going to put it in a high desirability category based on being able to be priced at or just below market against people who are priced at market. Okay, this is a huge win for foreclosure investors. For one thing, there are going to be more foreclosures. And that's an awesome place to start. More foreclosures equals more opportunities for investors like us to pick those foreclosures off. When there are more opportunities, there also tend to be less investors. When the market is fading a little bit, people who were making easy money in the previous market are now going to go, well, this is actual work to do to find the deals, to analyze the deals properly, to fund the deals using hard money, which has also gone up in cost, right? To do the fix is going to be a little bit harder. You're going to find actually more people to do it, but there's going to be some work involved with setting it up. And finally, selling the property is going to take way more work than just putting it on the market, yelling house for sale, and having somebody come along and buy it. As a result, less investors are going to hop in the market. Is this a good time for you to get in? Absolutely, positively it is. Because when everybody else is leaving the market, this is the time when I entered the market last time where I learned the ins and outs of how the market operated with less competition and the ability to do deals that, although I wasn't making the massive margins I started to make later on in my career, I was able to learn the business in a very predictable manner and make a lot of money doing so. So your opportunity to get involved in real estate investing is actually right now. Okay, you want to hop in today, do your first deal, because there are opportunities out there. We won't have the bidding wars. Yes, it's going to take longer to sell, but we also should be able to do a lesser remodel on the property because the house just has to be nice now and priced really, really well. I can help you to do that. With my coaching program, I will walk you through how to find, figure, fund, fix, and flip a foreclosure deal, and I guarantee your profit of $25,000. If you don't make $25,000 on the deal, we will work again until you do make a minimum net of $25,000. So my coaching investment is an absolute positive no-brainer. You cannot lose on this investment as long as you are A, coachable, which means you do what you were told to do, and B, you have the financial resources to buy into a deal. If you've got those two requirements, if you believe that you're coachable and you've got about 50,000 liquid is the goal. Now, if you don't quite have 50 grand, we can look at getting a home equity line of credit. I have a client working on that right now. I've got business lenders who will give you credit to put down on your deal. So you need to have solid credit to do it. But the preference is that you've got 50,000 or so liquid that you can put down on the property. We will escrow for the remodeling cost on the property, and you will walk out of a deal with your $50,000 back and another $25,000 in minimum profit with my program. This inverted bond yield means the market is taking the shift that we knew was going to happen a year ago. We've been predicting it for a while, and smart investors are going to get in on this market shift and start to buy deals. This is an excellent time to be under contract or starting construction on a deal. It's a little bit slower right now. You get it done in about 30 to 60 days that you're spending on the remodel, and you're back onto the market in February or March when things are starting to warm up again, both physically and the market. And so you've got a huge opportunity on buying a deal right this moment. By the time spring rolls around, you're listing that property, it sells in the heated market, and you're buying your next one to get another one done by summertime. Right? And hopefully you get the summertime one done right about, the end of summer. You got a little bit more time in the fall, right? So you get one more done in the fall time frame. My goal for my clients is to do 4 deals a year at a minimum profit or average profit, let's say, of $25,000. So that's $100,000 a year in income that you're making as a result of my coaching program. If this sounds like something you want to do and you understand a little bit, you don't need to be a full market expert on the inverted bond yield. Don't worry about understanding this in a deep degree. Just get the basics. We have interest rates in the short term are now higher than interest rates in the long term. That is abnormal. It's inverted based on where the bond yield should be. And as a result, we are likely, according to every time this has happened in the past, heading into more recessionary climate. If that is the case, the pressure on the retail market will be felt a little bit. We're definitely going to see a slight dip in prices. We've already seen a bit of a dip. The expectation is a slight dip, a little bit lower than where we are right now. But nobody's implying that it's going to be this huge drop in housing prices. Why? Because there's still a shortage of inventory. People still need to own homes, period. It's just a question of making them affordable, which is largely driven by the interest rates that are now starting to come down. Okay, so we know that the market's going to hold stable, maybe dip a little bit and then pop right back up. That's the nature of the housing market. What is a little less certain is when we're going to be in the best prime market time again to sell. So if you buy something right now, you are hedging your bet to get back into the seasonal uptick that's going to happen right about this first quarter, second quarter of next year. So you really want to be looking at doing a deal right now. If this sounds interesting to you and you're looking to do your first or next deal as a real estate investment, I would love to chat with you to see if coaching is the right fit for you. Okay, we're going to walk through the process of finding a deal, figuring a deal, funding the deal with my hard and private money lenders, fixing them with my list of contractors that I've worked with, and then flipping that property at a minimum profit on average of $25,000, okay? If you want to do that, slide up in my DM, send me a message. Let's hop on a call, 30 to 45 minutes. It's my coaching assessment call. There is no cost to you for the call at all, where we're going to discuss in detail whether getting foreclosure investment coaching is the right fit for you. I am certain that if you got the capital and the desire to hop in the market, there may never have been a better time to get into real estate investing than right now, and I certainly want to help you to do it. All right, guys, I'm going to open it up a little bit for comments and questions. Anybody watching right now, please hop on, shoot a comment, say hi. Let me know you're here. Ask any questions that you have. We have our weekly event that we've been doing at Bell Brothers Brewing. In the winter, the turnout's not been great, but we're going to be starting that back up at the new year. So stay tuned for that. We'd love to have you guys come out. We can meet face to face and discuss it. But most of my business is done virtually now on Zoom calls. So let's hop on a Zoom call and discuss your needs in real estate investing. Whether you sign up for coaching or not, I would like to be your trusted advisor in the real estate space, helping you to make the best decisions in your real estate investing world and helping you to make more money in doing so. Listen, happy clients and associates and friends make my life all the happier. I just want to advise you on what the best path is for you. Okay, guys, that's pretty much our show for today. Again, I thank you guys for tuning in each and every single week to the Foreclosure Deals live Q&A session with yours truly, Donny Coram. Please message me if you're looking to hop on a call and discuss whether coaching is right for you. And remember, now and always, don't buy a house, buy a deal.